Hello, everyone, and good afternoon. I first want to thank all of you for spending your time with us on this webinar today. My name is Catherine Grout. I've recently joined the Copenbarger law firm as an attorney practicing in our business and tax department. It is my pleasure and honor to speak to you briefly about our firm and then to introduce our speaker today, Sunny Boren. Before we get started, for anyone who doesn't know us or hasn't been to see us in a while, we have added a few new faces in the past year or two, myself included. I want to give a quick introduction or reintroduction to certain members of our team and certain departments. We have quite a large team of attorneys that not only focus on estate planning, but as you see on this slide, and as is apparent with this webinar, we have dedicated attorneys ready to provide more advanced planning and tax advice. Our business and tax team is also here to help you with entity formation and annual filings. Whether you have an operating business or you have rental properties you need to put into an LLC. We also have an estate administration department. Whether you're concerned with how your loved ones will manage your estate when you pass, or if you are managing the estate of a past loved one now. The estate administration process can be daunting, especially at such a challenging time in your life. Our estate administration team is here to help you navigate this. We also have an estate litigation department. Our experienced estate planning attorneys take as many precautions with you in the planning process as they can to help your families stay out of court. But we do understand sometimes litigation is unavoidable. Whether there was a miscommunication or a disgruntled individual, and now unfortunately your family is dragged into court, the good news is that the Copenbarger law firm can help. With a wide variety of legal services we provide, we can keep everything in-house when it comes to your planning needs. Of course, we cannot do this without our incredible staff. Our staff is the reason that we have been able to serve as many clients as we have for as long as we have. In fact, we just surpassed 45 years in business. The people pictured here help make sure that your questions are answered in a timely manner and make sure that we are able to assist you as efficiently as possible. We have offices all over the state. So the great news is that for most of our clients, we have a physical location close to them. And for those that fall outside of these metropolitan regions in California or have difficulty coming in person to one of our offices, we can also perform our services remotely over Zoom or even over telephone. So we can accommodate your needs and preferences. Just let us know where, when, and how. And for now, I'll pass this to our very own preeminent tax and advanced planning attorney, Sunny Boren. Sunny brings a wealth of expertise. She utilizes her CPA background and tax law expertise, focusing on estate planning strategies like irrevocable trusts and charitable remainder trusts in order to minimize capital gains taxes and leverage charitable deductions. I am very thrilled that we have her today to discuss the future of the estate tax exemption and how it may impact you. And Sunny, please take it away.
Good afternoon, everyone. I'm very thrilled to have Catherine now on staff with us. So we're going to talk today about time is running out on the Trump huge estate tax exemption. And here's what you need to know. So my agenda is current law for gifts and estates, upcoming changes in that law, dramatic changes, some of our solutions, some of our best solutions for your consideration, and how we can help implement. So the current gift and estate tax law is as follows. Okay, this slide's pretty simplistic, but you guys all know what gifts are. They're lifetime transfers without consideration. as far as the tax is concerned, you're generally going to be taxed on the value of consideration gifted, but there are some exceptions. One, many of you know about already, the 18,000 per person annual exclusion. That's per beneficiary. So husband and wife can each give 18,000 to son Mac, etc. And as a general rule, all spousal gifting is not included in taxable gifts, and charitable gifting is not a taxable gift. So that's the gift side. Now, this is a huge exemption that covers both gifts and estate assets. So the estate assets are what is left after when you pass away. So there's one big exemption for both gifts and estate transfers. It's right now 13.61 million per person, or double that, 27.22 million per couple. But for today's purposes, I'm going to round those numbers to make them easier to say and easier to think about. I'm rounding the current exemption, combined exemption, to 14 million per person and 28 million per couple. Now, here's the big disclosure. The sunset of this law that I just told you about is going to occur under current law at the end of 2025. So the exemption will decrease. Both these numbers are going to cut in half. To the exemption at the end of 2025 is going to be 7 million per person and 14 million per couple. And the tax rate for present purposes always remains the same at 40%. So as an example, for a couple with over 28 million, excuse me, we're contemplating that the most advantageous net worth is going to be 30 to maybe 60, 70, 80, maybe 100 million for your consideration. So if you have over the 28 for a couple in 2024 and or 2025, here's what you can save. If you use 14 million of exemption, which expires at the end of 2025, per current sunset law, quote unquote, you can save $5.6 million in taxes. And you can shift those dollars to your children, grandchildren, church, or other 501c3 and get a lot of joy in doing that. I want to show you how I calculated that tax savings, though. It's just 14 million of exemption times the 40% rate equals 5.6 million. Or actually, for a couple, if you both made those 14 million gifts, you'd save a whopping 10.2. Is that true? No, 11.2 million. So a lot of disposable income that you could be, assets / income that you could be doing great other things with. I'm going to disclose and tell you about a different law that really has nothing to do with the exemption, but is a clawback. So in the last 3 years of your life, if you give any kind of gift, that's considered to be made in contemplation of death and is clawed back into your estate as if that gift wasn't made. So it's going to be subject to estate tax if you own more than the exemption at your passing. So keep your current life expectancy in mind when you're thinking about gifting. Now, here's a pretty slide, but it's also very important. We're going to keep reminding you today that if you don't take advantage of this hugely favorable law, it's going to expire, maybe even sooner than you expected. Congress has got a budget and a deficit in that budget that it's concerned about with all the its gifting to foreign countries who are warring against each other. And it would not be completely shocking, in my opinion, if this exemption is decreased sooner rather than later. Perhaps by mid-2025, they would cut the exemption because it's a quick way to get a lot of money from very, very wealthy people. And they could use those funds. So I just want to tell you, by saying that, I'm not trying to generate fear, but moving quickly on this is really, really important. If you don't, you could lose the opportunity to save that 11.2 million and to potentially do a lot of good for your church and or family and or other charitable causes. So we're highly recommending that you call in promptly to get your spot on the schedule with Lloyd and I to talk about this. And let's talk about some of our solutions, what you can do. These are a couple of irrevocable trusts for particular purposes. They're very common ones, they're very common ones, they're very safe ones. A QPERT, or a qualified personal residence trust, is for you to put your residence in, transfer your residence to this trust. And it will then be protected for future generations. It will be protected irrevocably from creditors, and it will stay there for the term of the trust. And then at the end of the term, which may be 5, 10, or 15 years, not overly long, it will transfer to the residuary beneficiaries, where you will have to start paying rent. But that's not a problem in this high net worth planning scenario, because that means you're further reducing the value of your estate subject to taxation. And you get to live in your home, think of it as your home. Everything remains the same, except for some documentation. Next, you likely have heard of an ILIT, an irrevocable life insurance trust. Those funds can be very useful to the survivor after you pass, to have the funds immediately or almost immediately. But they can also be used to pay estate tax if needed. And finally, they can be used to buy assets out of your estate and keep those assets in the irrevocable trust for the future. Those are two trusts we expect a lot of people to be asking for, in addition to others. So very powerful estate minimization trusts are the IDGIT. Don't know if you've heard of it. That's short for, an acronym for Intentionally Defective Grantor Trust. High net worth CPAs and attorneys throw the term around a lot. And what it is the grantor, usually the parents or grandparents, make a relatively large transfer to the trust. They're not going to be able to access these funds anymore. They're going to be held in trust for the longer term often for their children and grandchildren. But it's an irrevocable gift to the trust. And of course, there are some ways to get around if you really need to. But think of it generally as being irrevocable. When you come in to talk to us, we start putting in buckets your various assets. So ones that are perhaps up for sale in the not distant future, the miscellaneous ones in the middle bucket, and the final bucket is assets that you really intend for your family to keep for the long term. Those are the ideal assets to put into this trust. And an ideal way to leverage the amount of exemption used is to put the assets first into an LLC. You can even bifurcate the ownership of that LLC into non-voting and voting interests. And temporarily, at least, you could keep that 1% voting interest, or 2% if husband and wife both want a 1% interest. So you get to do all the decision making for some time anyway. And then the 99 or 98% non-voting interest would go into the trust. You'd keep that 1 or 2% in your revocable trust. And you'd get maybe a 30% discount on the value of those assets, because that non-voting interest does not have any marketability out there in the market. Nobody wants to buy 99% of your commercial property, for instance, because they couldn't transfer it. So you can compress the amount of exemption used. And then the beneficiaries are going to be probably first your children, and second your grandchildren, not the two of you, not the two of the couple. And we have different kinds of ways for the children in particular to maintain flexibility with a special power of appointment. If one of their kids maybe is not acting as they wish, making choices that aren't the very best, they can change which of the grandchildren take and in what percentages. So there's some flexibility there. It's really nice to have. And various things. I've got a fancy spreadsheet that tells you about all the different options you can utilize if desired. And we carefully craft these trusts to avoid IRS audit. You can do that. And they can just be plain vanilla, but save you lots and lots of dollars. Now, a variation of an IDGIT is a SLAT, another acronym for, and it's beautiful, for Spousal Limited Access Trust. It's very, very nice having the spouse able to get funds, whether they're needed supposedly for support and maintenance and health, or not really needed for such a serious use, but for a discretionary use of income or principal. The ticket to getting that ability for those kinds of distributions is to have an independent trustee. Because if they're not related to you, they can't be forced or pressured into making gifts, that means, then they're allowed to exercise broader discretion in making that gift to a spouse. That could be really appreciated in a certain year. They want to take a special vacation or something. Now, often both spouses want to form a SLAT and make this kind of gift. And there's a couple of tricks to keeping it safe if you do that. But one that I highly recommend is making gifts in separate tax years. This is a tried and true IRS evasion, no, not evasion, IRS avoidance technique to straddle tax years. So in that case, to use this exemption, this expiring exemption, you'd need to form one of the slats in 2024. So you'd need to get on our schedule ASAP. And then the other one would be formed in 2025. And I've got other ways of keeping you safe, but this is the most important one, really, is straddling tax years. A few more points about IDGITs and SLATs. As I've already said, you want to analyze your asset types, whether they're long-term or short-term, especially protecting those ones that you want to keep in the family, maybe an heirloom home. There's been a study done not that long ago that says that without a trust, without the protection of a trust, generational wealth can be drained in large part, 70% plus, over just 3 years. I guess it proves that some beneficiaries can't be trusted, and they like to spend when they finally get their hands on or their availability of some assets. So having an idjit or a slat can be very, very beneficial to them to not overspend, protect them against themselves. And specifically, it's called a dynasty trust if you keep it for three, if it is going to last for 3 or more generations by its terms. Some people don't really even want that and trust their kids and grandkids, but that is available if you'd like to use that term. Now, charitable trusts, as Catherine noted, can be very, very beneficial in several ways, but especially tax-wise for you. There are charitable lead trusts, which you can form during life or at death. And there are charitable remainder trusts, which you can form during life or at death. The lead trust gives charity the first cut. So for 5 or 10 years, perhaps, you make all the income from some assets available to charity, and that's distributed annually or so. Then the trust terminates and you get the assets back, the principal back. On a charitable remainder trust, it's the opposite. You transfer the assets in. That's an irrevocable transfer. So you'll know in both cases, actually. Now, this reduces the size of your taxable estate rather than per se using exemption. And let's talk about some of the benefits to you. They're pretty flexible. It's a wonderful benefit to you to give an appreciated property to the trust and then have the trust sell the property and then have all the liquid assets to generate income. You can give part of that property, not the whole thing, but the benefits start to you then from a tax perspective. One, you delay the capital gains tax. It's not all paid all at once. It'll be paid in increments as going down to the bottom bullet. You keep the entire income stream for your life, and you can receive that monthly, quarterly, possibly annually, but that will be taxable income, but a big chunk of it will be taxed at the beneficial, very beneficial capital gains rate, which is 20% maximum for people in the highest tax rate bracket. And instead of paying it all at once, it's paid over the years. And then you get a huge charitable donation, deduction, excuse me. Not just in the year of gift, but in the 5 following years. And as I said, you keep the income stream for life. And only after the second to die of a couple will that residue go to charity. Foundations are also very beneficial. A private foundation can receive a gift of appreciated property also and pay no capital gains tax at all. And the wonderful benefit is you get to choose your mission, whatever is specifically useful and beneficial to your heart. Maybe your denomination, if you're a churchgoer, maybe gifting to artists, up and coming artists. I'd love to help with that. You have to set up some specific protections, but nothing hard for you. We do all that work for you. And then you get complete control as a single person or as a couple until you want to give control to your descendants. One example that we thought about doing recently for someone, a client, is granting scholarships. Some would like to grant PhD type scholarships. She wanted to grant soccer camp scholarships. And it gave her kids a great treat thinking about doing that. So again, in the charitable arena, this reduces the size of your taxable estate as opposed to having to use exemption. So it's nice to have charitable trusts and the idjit slat scenario and or Cupert's and an islet, because in a way it varies the risk. You know, if some kind of trust should possibly fall into dislike at the IRS, highly unlikely on all of these. We've chosen very safe ones. But you have different parts of your life that you want to benefit. And having a nice diagram full of trusts can be very meaningful if you've got a lot of assets to work with. So how we can help. We can expose you to some possible other types of trusts that might be a little less safe. Like I said, we've highlighted today the safest ones from an IRS attack perspective. We want to discuss those with you and talk about your tolerance for risk. Talk about trust funding choices. And I like to diagram out where the various asset types are going to go. Show you full color diagrams on both that and where your cash flow is going to go once it's all set up and in place. And then we, without fail, always want to talk about the different kinds of taxes also, not just estate and gift, but income tax, as I've talked about a little here, mainly from the basis and capital gains perspective, but also on property tax, especially in California. Most people really want to avoid an ongoing increased property tax, because that hits you every year. And we're capable of having all those discussions with you. So what we can present to you is a professional a couple of professionals who understand the tax law well and the changes that occur in that over time. We understand making a specialized plan with even things like a domestic asset protection trust, which literally is usable. Those funds are usable by the grantors, both of them, but they cost more too. We can customize provisions to fit your needs, and we always know what needs to be done and when. So to plug our firm, we are qualified professionals. We've been around for 45 years. As Catherine said, we have 8 full-time attorneys, 2 attorneys of counsel, and a CPA, which is me. We have, I think, even over 350 years of combined attorney experience with a lot of advanced tax degrees and certain specializations in probate, estate planning, and trust administration. And as you saw the picture at the beginning, we have 45 plus highly qualified support staff who are diverse and have diverse skills also, with 8 office locations and a wide willingness to speak with you by Zoom or phone if it's not convenient to come into multiple meetings. So we can give you the tools to take care of your family for many years to come. And I personally highly recommend that you think about doing these kinds of planning for irrevocable trusts early while you're alive and well. So many people put it off. It's very easy to put off estate planning generally, but these particular uses of irrevocable trust to use exemption needs to happen ASAP. 2024 is the perfect year to begin this gifting because that exemption could be moved forward into exemption expiration, I should say, could be moved forward into mid 2025, even the end of this year. And we'd hate to see you lose the opportunity. So Lloyd and I warmly invite you to schedule with us to discuss this kind of planning. And here's some numbers that you're going to need. Thank you so much for your attention. It's been wonderful sharing with you today, and we hope to talk with you in person or online. Have a great day. Bye now.